Well, good afternoon, everyone. It's a great pleasure to be here this afternoon. It's a great pleasure to be talking about moly and cobalt rather than the sale process at the LME, but that's for another day. Right, my presentation this afternoon, I'm going to look at three main questions. What progress have we seen since the launch of the contracts? What sort of questions are we coming up against when we're out on the road talking to people about the contracts? And how do we see things progressing from here? In terms of the progress, those are the numbers. Clearly, the emphasis has been, or the success has been, in cobalt. Moly is obviously taking a lot longer to gain hold in the market. In terms of the cobalt, I can say that yesterday we reached record open interest for the contract. We hit more than 560 tonnes. It's been a busy past few months. I would say that we've started to see traction in the contract, real traction growing from about December. December was a record month with more than 1,000 tonnes traded. Looks like March is going to be a new record, and since the start of this year we've seen about 2,000 tonnes traded, all of which is very positive news. Less positive is moly, where progress has been patchy. You see it's up and down. I mean, in terms of tonnes and value, it's not too far adrift from cobalt, but I think that it's fair to say that the action, the pace, has been with cobalt. Been a broad variety of trading over different prompt dates, different types of trades, and that's a good thing to see in both contracts, actually. With regard to the physical aspects, physical delivery aspects of both contracts, I think we've got a good range of brands that can be delivered physically and in different locations. Here are a number of the, actually most of the cobalt brands, and here we have the moly brands. Delivery around the world. Very important aspect to the LME is the physical delivery. It's the delivery in and out of warehouse that drives the price convergence for our contracts. What we want to see is metal coming in and metal going out, and this slide here, I think you can see quite clearly there's been plenty of activity in cobalt. Since launch, more than 1,000 tonnes in, more than 700 out. Every week there's some sort of activity, and in most locations. For the main, it's Rotterdam that's seen the activity. We also have Antwerp listed as a location, and maybe we're going to see some action there as the month goes on. Moly, I think it's interesting to see that we have seen deliveries out as well as in. One of the concerns with the contract when we launched it was the physical delivery process. Well, I'll tell you that it works. The deliveries out of warehouse haven't presented issues at all. In terms of where the trading takes place, a lot of it is in the telephone market. We're seeing more on the ring with cobalt now, and I think that's probably a function of cobalt becoming adopted in contracts for delivery. Therefore, it becomes more important for prices to be discovered on the LME. It was interesting to see the slide from our presenter from Crew just before lunch, and you see a clear pattern where the LME is starting to sync with the MB price. I'm entirely sure that's a good thing, and I think that probably to some extent we are comparing apples and pears, but I think the broader point is that there is a increasing usage of the cobalt contract in the physical market and an arbitrage between the LME price and the MB price. Here are some of our ring traders. We're seeing roughly half of them participate in the cobalt and moly ring each day. That's clearly very good news for those that you that don't know it. Ring trading for cobalt and moly is at 12.20 every day, just after the nickel ring. This is a screenshot of a page on Bloomberg. I could equally have taken Reuters or National Pages, actually, the LME system. The point is that it's now becoming possible to follow certainly trading on cobalt on LME Select every day. There's a good two-way spread, bids and offers, and over the last few months we've seen increasing activity on Select. That's clearly a very positive thing. In some ways, it takes me back to my days as a reporter at Metal Bulletin pricing the cobalt market, when the first thing I'd do every day would be to look at the WMC screen. I think we're now in a position where looking at the LME screens, the LME cobalt pricing pages every day, you can get a fair reflection of the market. The sort of questions that we get on the road, when will the contracts be liquid? And to some extent it's a chicken and egg situation, in that the more liquidity there is, the easier it comes for people to get into the market. We quite often hear disappointment among consumers or indeed producers that they have 10, 20 tonnes to do, but they can't do it. I think there are ways around that in terms of leaving resting orders or going into the market for small tonnages. But the point is that there clearly is an interest there, and it's a case of waiting for the liquidity to be able to capture that interest. And certainly these things do take time. This is a slide showing the build-up and activity of the aluminium contract, which is now the exchange's largest contract. 40% of our volumes are aluminium-based. And it wasn't really until the implosion of the Soviet Union and the aerospace industry there, and the flooding of the European physical markets with aluminium, that created the circumstances in which the industry moved away from its traditional pricing models and began to use the LME, its pricing, its hedging mechanisms, its warehouse mechanism as a viable alternative to what had gone on before. Entitled this slide, "What Would Jesus Do?" This is a picture taken from just outside St Paul's. For those of you visiting London, it's probably worth going down there just to see what's happening. There's a tented city, and I think there are tents on Wall Street as protesters protest against the banks. And it's fair to say that bankers aren't the world's most popular people at the moment. And I think that there has been concern that the bank involvement in the minor metal markets is a cause for concern. I think the concerns are overstated. I think when people are talking about speculation, the main concerns are manipulation. I have a price chart here. I mean, it could be any commodity. In fact, it's a fine wine, which I think goes to show that it's not just a moly, it's not just nickel, it's not just aluminium that have been affected. And probably the increase in wine prices is to do with the same reasons as what we've seen with moly in terms of growing demand in China. This slide shows the volatility of non-exchange traded commodities. Here we have the exchange traded commodities. So I think the two things to notice here. One is that just because it's on the exchange, it doesn't make it inherently more volatile. The second more broad and important point is that if it is on exchange, at least you have the ability to do something about it. So that kind of answers the next question. What's the point of it? These are volatile markets. They've always been volatile. At least you can now manage your risk in a more effective fashion. In terms of what we see next for the contracts, I'll take you back to the slide I had earlier. It's a good start. I think Cobalt, we're actually on the way now to having a viable contract. Still not quite there. I think that liquidity needs to grow to facilitate more trading, and the signs are that that's happening. As I said, the ability to look at select our trading system in the morning and see a price, I think, is a very significant moment in the contract's development. I'd also make reference to a comment that Marcus Moll made earlier in terms of talking about the alloy surcharge and his contention that for the nickel industry, the best thing they could do would be to offer a fixed price rather than an element of fixed price and surcharge. And his logic, and I wholeheartedly agree with it. I don't always agree with Marcus, but on this particular occasion, maybe for slightly different reasons. But his logic being that it's all about service. If, as a producer, you can offer a fixed price to your customer, you're offering them customer service. They are more likely to want to do business with you than if you're, frankly, just sticking them with a surcharge. The way that you can do that and protect your profitability at the same time is by hedging the raw material cost on the LME. So the two go side by side, customer service, profitability. To do that effectively, you need to be hedging, you need to be using the LME. In nickel, you've been able to do it for years. In Cobalt and Moly, that process is just starting. Thank you.
Thanks, Chris. Do we have any questions? Down here at the front.
Thank you. Chris, this morning we have talked about nickel. Now you have given us an insight about cobalt and moly on the LME. What about steel on the LME? Because all of these are ending in steel somewhat.
Yes, we have our billet contract. I think that the ferrous markets are ripe for risk management, better risk management. Marcus's slide with the profitability was a pretty atrocious picture, frankly. It's the same deal with the carbon steel mills. There are a number of exchanges that have created ferrous products. We're not the only show in town. We have our billet contract, but other exchanges have products for iron ore, hot rolled coil. The fact is, though, that it's a slow progress. It's a conservative industry. It's an industry that hasn't had to follow best practice in terms of risk management over the years. If you look historically, particularly in the European Union, but also outside the European Union, there's been a history of mills going to politicians and asking for help, be it in terms of subsidy or trade protection mechanisms that happen in the States on a regular basis and in Europe. And so there hasn't really been the focus on customer service or indeed shareholder service. That is changing. It's going to take time, but I think the breakdown in the iron ore benchmarking system has probably brought home to
the mills and certainly their customers that things can't go on as they were.
Any further questions? Maybe if I can just throw in my tuppence worth, if I may. What do you think are the sort of key drivers that lead to the increase in volume of trading a metal on the LME? Because cobalt clearly has more volume going through than molybdenum. Is there something fundamentally different between those markets that means that cobalt is going ahead and molybdenum is slowing down? Is there something you can put your finger on that?
I think that the moly industry is probably more conservative than the cobalt industry. I think there's probably more of a trader mentality in cobalt. I think principally, though, what we're seeing at the moment is that a number of transactions, maybe formula-based transactions, are now basis the LME, and so those who have concluded those deals have an interest in influencing the LME price, and also a desire to use the LME to offset the purchase and sell risk, and that sort of starts feeding into the market, and we get to a virtuous circle where, because of the usage, because of the liquidity, more people want to use the LME in their physical contract.